All right, listen up. We're talking flat markets today. You know what I mean? The market isn't rocketing to the moon. It's not crashing through the floor either. It's just stuck in the mud. It's doing the sideways shuffle. Some people, they hate these markets. They call them boring. They say you can't make any money. Wrong. They are so wrong it's not even funny. These are the markets where the smart money, the mad money, can still find winners. You just need to know where to look and how to play the game. It's about strategy, not speed, in these conditions. A flat market, or a range-bound market, is when prices trade between strong levels of support and resistance. Think of it like a ping-pong ball. It bounces up from a low point, that's your support. Then it hits a high point, that's your resistance, and bounces back down. For days, weeks, sometimes even months, a stock or the whole market can just go back and forth. No big breakouts, no dramatic drops, just this channel. This can be frustrating for folks who are only looking for those huge, explosive moves. But for us, it's a different kind of playground, a different kind of opportunity. Now why should you care? Because these flat periods happen. They happen a lot. You can't just sit on your hands and wait for the next bull run. No. You need to be ready to make money in all market conditions. That's what separates the pros from the amateurs. Understanding flat markets means you're adding another tool to your financial toolbox. A big, powerful tool. It means you're not scared when things quiet down. Instead, you see the signals, you see the patterns, and you get ready to pounce. So don't let these sleepy markets fool you. There's action to be had. There's money to be made. You just need the right game plan. And that's what I'm here to give you. We're going to break down why these markets happen. And then, the best part, I'm going to show you how to trade them. How to turn that sideways shuffle into a money-making dance. Booyah! Get ready, because class is in session, and this is knowledge that pays. So why do markets go flat? Why do they decide to take a nap? It's not random, folks. There are real reasons. One big reason is what we call equilibrium. That's a fancy word, but it just means buyers and sellers are pretty much balanced. There's no big rush to buy, there's no mad dash to sell. The bulls and the bears are in a stare down. They're matched in strength for a while, so prices don't have a strong reason to go much higher or much lower. They just kind of hover, waiting for the next big piece of news or a shift in sentiment. Another classic reason for a flat market is low volatility. Volatility is just a measure of how much prices are swinging up and down. When volatility is low, the swings are small. This often happens during holiday periods. Think summer months or around Christmas. Trading volume, the number of shares being bought and sold, tends to dry up. Fewer players in the game mean fewer big moves. Or it can happen when everyone is waiting for something. Maybe it's a big Federal Reserve announcement on interest rates, or a major earnings report from a bellwether company. The market holds its breath. Consolidation is another key factor. Imagine a stock has made a huge run-up, or maybe it's taken a big dive. After a big move, the market needs to catch its breath. It needs to digest what just happened. This breather period is consolidation. Prices will trade sideways as investors figure out if the new price level is fair. Is it too high? Is it too low? This tug of war during consolidation creates that flat, range-bound action. It's like a pause before the next chapter, building energy for the next potential move, up or down. And sometimes, let's be honest, the economic news is just blah. No big surprises, no major shocks. Growth is okay, but not great. Inflation is in check, but not disappearing. When the overall economic picture is a bit dull or uncertain without being scary, markets can reflect that. There's no strong catalyst to push things decisively in one direction. So investors play it safe. They stick to the sidelines or make small moves, leading to that familiar sideways drift. Understanding these whys helps you spot these flat periods early. Alright, the moment you've been waiting for. How do we make money when the market is doing the cha-cha sideways? Strategy number one, my friends, is called range trading. This is classic. You identify that support level, the floor, and you identify that resistance level, the ceiling. When the price bounces off support, you buy. When it hits resistance, you sell. Or if you're more aggressive, you can even short sell at resistance. It's like playing tennis. Buy low, sell high, within the defined court. Simple, effective, beautiful. For example, let's say stock XYZ has been trading between $40 and $45 for a month. $40 is your support. $45 is your resistance. You see it dip to $40.50 and start to turn up? That's your buy signal. You ride it up towards $45. As it gets close, say $44.50 and starts to stall, That's your sell signal. Ka-ching! You pocket the difference. Of course you need to set your stop losses. If it breaks below support, you get out. Don't be a hero. Protect your capital. This strategy works best when the range is well defined and has held for a while. Strategy number 2 involves options. Don't be scared. Options can be your best friend in a flat market, especially selling options. Think about strategies like an iron condor. This sounds complicated, but it's about betting that a stock will stay within a certain range. You sell a call option above the expected range and a put option below it. As long as the stock price stays between your short strikes by expiration, those options expire worthless, and you keep the premium you collected. Booyah! It's about making time work for you. Another options play is selling covered calls if you own the stock. If you own 100 shares of a stock that's just drifting, you can sell a call option against those shares. You collect a premium. If the stock stays flat or goes down slightly, the option expires worthless, and you keep the premium, adding a little extra income. If the stock does go up and gets called away, you still made money on the stock and the premium. It's a way to generate income from a stock that's not doing much. These option strategies are about probability and time decay, which thrive in sleepy markets. Now let's talk pros and cons. For range trading, the big pro is clarity. The buy and sell points are usually pretty clear. Support and resistance are visible on the chart. This can make it less stressful than trying to guess the next big trend. You have defined profit targets and defined risk points. It can provide a steady stream of smaller wins if the range holds. The repetition can be comforting and profitable. You know the boundaries of your playground. But there are cons to range trading. The biggest risk? A breakout. If the stock suddenly breaks through resistance or crashes below support, and you're on the wrong side, you can get hurt. That's why stop losses are critical. Another con is that profit per trade might be smaller compared to catching a big trend. And sometimes a range looks solid, but then it narrows, or the stock just hovers in the middle, giving you fewer chances to enter at the edges. Patience is key, and false signals can occur, leading to small losses. For option selling strategies like iron condors or covered calls, the pros are juicy. You make money from time decay, which is on your side in a flat market. Theta, as we call it, is your friend. You don't need the stock to move much or at all to profit. You're essentially betting on inaction. It can provide consistent income. And with defined risk strategies like the iron condor, you know your maximum potential loss up front, which is great for managing risk. You are selling insurance, and when nothing happens, you collect. The cons of option selling? Well, if the market makes a sudden, sharp move against your position, losses can be significant, especially with undefined risk strategies if you're not careful, though I recommend defined risk. For an iron condor, if the stock breaks out strongly in either direction beyond your short strikes, you lose. For covered calls, if the stock price skyrockets way past your call strike, you miss out on those extra gains because your shares get called away. And options require more learning. You need to understand strike prices, expiration dates, and the Greeks. It's not for the absolute beginner without some homework. So, what's the bottom line? Flat markets are not a dead zone, they are an opportunity. With range trading, you play the bounce. With option selling, you get paid for waiting. There are ways to make money, folks. You just need the right tools, the right mindset, and the willingness to adapt. Don't fear the flat market. Master it. Learn these strategies, practice them, and you'll find that even when the market is sleepy, your portfolio can still be wide awake and working for you. Booyah! Now go out there and make some money.